a little bit about me. As Nigel said, I'm by background a financial journalist. I spent 15 years at the Financial Times, so quite rooted in finance and business. And I was, as he said, for the last 3 or so of those years, the editor of the Weekend FT, which was great fun and a bit less financial. Since 2010, when I left there, I've essentially become a kind of freelance roving writer, amongst other things. And it so happened that this movement got going, really started to gain some traction in this country around the time when I gained the freedom to spend some time looking at it and meeting the people involved in it. So I've written quite a few research reports. I've also got other involvements. I have become an equity angel investor in a number of the platforms themselves, so I've seen them operate from the inside, and I know the managements obviously of those platforms and the other investors very well. I've invested my money, in other words, I've lent money on peer-to-peer lending platforms, quite a number of them, so I've seen what happens when you do that, both good and bad. And I've written about them in quite a number of ways, research reports and journalism. So that's a bit about me. What am I talking about? Well, really the area that I've spent most time looking at and thinking about are the online operations, which are basically matchmaking services, bringing together people with money and people who need money in a sort of marketplace, virtual marketplace. You can call it, it's kind of online dating for finance, basically. That, this is the way that this market has developed. And that's really what's happened here is, people have, used the internet for all manner of things, and finance has latterly become one of them, which is becoming much more important. It's taken a lot longer to happen than things like dating or music sharing or publication of news and information, so on. Lots of other things happen much more quickly, but finance is getting there, and it's becoming quite large now. And it so happens that the UK is, for various reasons, a market where it is quite a long way ahead of almost every other market in the world. So we're in a very good place to sort of understand how this all develops. And it's, as I've said here, finance of all sorts. So it is equity investments into companies, usually quite young, early stage businesses. It's loans, simple lending to individuals, consumers, to small businesses, increasingly nowadays to property developers, and I'll talk a bit more about property as we go. And it's also other slightly more specialist types of finance, for example, like invoice discounting and lending against receivables, which is a recognised sort of niche in conventional finance. So those are the sorts of things that's really the big background to what I'm going to talk about for the next 15, 20 minutes or so. So some numbers. This just kind of this is roughly speaking the most up-to-date numbers available, and you'll see at the bottom, for those interested, there's been a piece of work published recently. This year's version is called Pushing Boundaries. It's the 2015 UK Alternative Finance Report, and it's published by Judge Business School in Cambridge in association with Nesta. And I know several of the people that are involved in writing this, and they're good, sort of sensible researchers, and they do a lot of work actually all over the world now. They're doing work in the US, South America, Europe, Asia. So they're trying to look at this globally, but they do a very good piece of work on the UK. And they concluded that in 2015, around about 20,000 small businesses received, as it says there, around just a bit over £2 billion in funding of various sorts through these online platforms. Now, the overall market, once you roll in consumer lending and you roll in donations and reward-based crowdfunding and all the other ways in which people provide money, was worth probably about 3.2 billion. And as I've said, the growth rate is still very high. In the last year, they're on their measurement, it's over 80% year-on-year growth. So, it's growing fast, but it's important to note that it's slowing. The previous year, it probably grew at about double that rate, at about 160%. So the slope of the line is it's still very quick, but it's starting to flatten off. And I think that's an important thing to note. Now, of that, where are we, 2.2 billion, as I've said there, about 1.85 was actually lending. So a lot of this was loan funding. A bit more was, the balance of that was equity. But also it's important to note that they think, and I cannot independently verify this number, but I think they're sensible, so I would say it was indicative at least, that getting on for 14% of all new lending to small businesses in the UK, including bank lending, was accounted for by these guys. So it's it's becoming a meaningful proportion of overall funding to SMEs in this country. And that's happened since the financial crisis. The first loan advanced on Funding Circle, which is the biggest and best known of the peer-to-peer lending platforms, was done in the latter part of 2010. They launched in August and their first loans happened in the last months of 2010. So, we're now talking 5 years later. By the last months of 2015, they and their ilk are accounting for almost £1 in 7 of new lending to small business. So it's becoming considerable. It's happening at a time when the larger market, the banking market, is undergoing obvious change. I mean, it's been happening for years, and this change just rolls on. And it happens because of the re-regulation of banks, which obviously curtails their behaviour and their risk appetite and what they're prepared to lend to. And in particular areas, this is becoming very apparent. So, for example, overdrafts, which is a classic way of funding a small business through peaks and troughs in the cash cycle. You take an overdraft to balance things out. Now, the number of approvals for smaller business overdrafts, this is all based on figures from the British Bankers Association that publish a quite detailed quarterly report, which they call Support for SMEs. Amongst smaller businesses, which they define as companies with annual turnover of up to £2 million, the number of small business overdraft approvals is down more than 40% over the past 2 years. So 3 data points, beginning, middle, end. Over those 2 years, there's a 40% drop in overdraft approvals. However, the approval rate of people who apply to get an overdraft is steady at about 78%. So in other words, around about 8 in 10 of small businesses that apply to get an overdraft get one. And that hasn't really changed a lot. What's changed is the number applying. So I'm not saying this is banks saying no. This reflects a lot of people no longer bothering to apply. That could be because they simply don't believe they will get a yes, so they don't bother. Discouragement. It could be for other reasons. One of them might be contained in these 2 points here. The BBA's figures cover the biggest banks, all the British banks. They don't cover the foreign banks, but there aren't really very many foreign banks operating in the UK market anymore. They mostly went home when the financial crisis happened. So, at the end of now that should say 2015, sorry, I've missed a 5 off there. Total borrowing by small and medium-sized businesses from banks, and that's loans and overdrafts which have actually been drawn rather than the facility, stood at £96.5 billion. A year earlier, it was 97.9, so there's been a contraction. They've been paying back loans and not taking new ones. Their cash balances, however, held at the same banks, are now standing at 163.5 billion from 152 12 months earlier. So smaller businesses are piling up cash in the bank, generally repaying bank lending and not tending to draw significant new sums. It is starting to go positive. They are starting to become net borrowers again from the banking system, but it's at a very, very low level. In other words, the decline is just flattening out. But this is a long-term trend. So the online guys have been growing against a background of a big structural change in the market, overdraft funding much less available, much less of it, and a lot more cash being held inside small businesses. Now that may be because the small businesses don't believe that if they go to providers of funding and ask for money, they'll get it. So they think, right, okay, we need to hold more cash. We need to have our own safety net. I mean, what's the substitute for an overdraft? It's money in the bank. That's how you manage cash flow. You keep money. So that's one of the things which is happening, I think. And that says something about the risk appetite of small business owners and their confidence in their ability to raise money when they need it. Now, it's also true to say that, as you know, people tend to call it the alt-fin movement, the alternative finance movement, is undergoing some really big changes and major developments, and a lot of them reflect a very high level of government, public policy support for these organisations. I mean, there is a real, you know, it's important not to, I think, to underestimate the government's desire to see a more diverse funding ecosystem for small businesses develop. So, for example, when the Competition and Markets Authority published their recent sort of interim report on personal and small business banking, they noted that something like 85 to 90% of all the lending to small businesses in this country goes through 5 banks. 5 banks account for about 85, 90% of the market, which is highly, highly concentrated. And therefore, if any of those banks, or indeed all of those banks, as happened in 2008, hit a problem, the market undergoes a very serious freeze. Lending stops, people stop being able to fund their short-term working capital needs, for example, and business freezes. And that's exactly what happened. It was a credit crunch. That was what it was known as. So obviously, in response to that, you want a more diverse set of sources for raising money. These guys are seen as an important part of it, and so things are happening. Like, for example, the Innovative Finance ISA, which will launch in April, and will enable anybody who opens one to invest now up to £20,000 a year in peer-to-peer lending, which can be lending to businesses or lending to individuals, and gain full tax relief on all their income and gains from doing so. Obviously, that primes the market with the potential for a lot more retail money to flow in. So there is plenty of lending capacity in prospect for businesses that wish to borrow. The peer-to-peer platforms and indeed the equity crowdfunding platforms have all now moved into the realm of full regulation by the Financial Conduct Authority. So equity platforms have had to be regulated from the start because selling equity to the public is a regulated activity and always has been. Peer-to-peer lending platforms have had a new set of rules written for them, which are now in full force. So from essentially 2 years ago, April 2014, anybody who was operating a peer-to-peer platform could get what was called an interim permission, and that enabled them to carry on operating while the FCA wrote the rules. From April this year, that's the point from which people need to start being fully authorised. And they are becoming fully authorised financial organisations with compliance people, with rule books, with policies on conflict of interest and all the other things, ways you treat client money and so on. So they're, you know, these are becoming part of the mainstream. I mean, it's debatable how alternative they actually are once they are regulated by the Financial Conduct Authority and there is an Innovative Finance ISA which can provide them with sources of money. We've also seen a number of investment companies, investment trusts as they're known, listed on the London Stock Exchange with the specific aim of raising money from selling shares in the trust to invest in peer-to-peer loans. So it's another source of funding for peer-to-peer lenders, and there are several of these now, and the largest of them is, I think, probably capitalised at about 700 or 800 million pounds. So of a reasonably substantial size, peer-to-peer global investments. There are several others. And increasingly, I think we will see platforms, So the larger platforms, and this has already happened with Funding Circle, which is the largest, will list their own dedicated investment trust on the stock exchange, which will become effectively a source of what's called permanent capital for the platform. So they sell shares in the trust, it raises money, the money is invested on the platform in loans, and that money lasts as long as the trust lasts and potentially permanently. This is something which has also happened a lot in the private equity market as well. People have raised permanent capital for private equity funds. Again, another sign of sort of a legitimacy of merging into the financial mainstream and of becoming a long-term fixture. And then I mentioned property a little bit earlier. Well, property is now certainly the fastest growing area of peer-to-peer business lending related to property transactions. And that can be of all sorts. It can be short-term bridging lending, which is usually to enable a developer to purchase a property, often at auction, to complete a purchase with a view to gaining planning permission, possibly undertaking development, and ultimately developing and reselling and refinancing the property. It can be lending to developers, which is sort of staged lending, so that at each stage of the development work, another chunk of money is drawn down to fund the next stage. It can even be mortgages. People are lending on buy-to-let mortgages. People are crowdfunding buy-to-let mortgages. They're crowdfunding commercial mortgages. Anything you want, essentially. Anything that can be funded any other way can usually be funded this way too. And, you know, as I've said, it's up, roughly doubled during 2015 against the whole business lending market, which probably grew about 50%. So it is significant and it's growing very fast. Property is important. But that's not, in essence, really a surprise, partly because Britain is obsessed with property. They love investing in property. It's everybody's number one favourite asset to invest in. And it's also because the smaller end of the property development market, the small house builders, the sort of small development companies and individual developers have found it very difficult to raise bank finance since the crisis. And actually the number of property developers, and particularly the number of house builders, has fallen a lot in this country. And the smaller end of the house building market has dissipated. And that's partly because banks went or emerged from the financial crisis very, very overexposed to UK property. And so the appetite to lend further against UK property was severely diminished, which meant that developers had to find new sources of money because the banks were very reluctant to provide it. So that's the sort of I would point to some of the big developments in alternative finance. Another overarching development, I think, is that, as I've sort of hinted at already, conventional and alternative, old and new, are increasingly merging and coming together and finding ways to work together. There are loads and loads of examples of this, and you know, I wouldn't necessarily want to list them all, but I think there are some important ones. For a start, lots of institutions are now seeking to lend in the sort of direct peer-to-peer way that the platforms allow. It's tending at the moment to be smaller fund managers, family offices, which are usually sort of small private organisations that invest a single wealthy family's money or a group of wealthy families' money. Hedge funds are major players in this area. And they generally like it because it's an alternative to the other sorts of lending that they can become involved in, so bond markets, for example. It's quite high yield. These are the borrowers here pay quite high interest rates in general for the money. And it's generally seen as uncorrelated. So in other words, when one thing goes wrong, maybe this doesn't. So it gives them a sort of diversification of risk as well. But there's quite a lot of institutional money now entering this market. And one of the things which is driving its growth is that institutional appetite to lend, definitely. I think it poses some sort of, perhaps not quite existential, but some moral issues for the movement, which we'll come to. But equally, the people that run these platforms are entrepreneurs. They want to create large businesses which they can sell in order to become very wealthy, and institutional money helps that to happen. Not only because it provides cash, but because institutional investors are professionals and they will undertake much more thorough due diligence on the platform before putting money onto it than an individual would be able to do. So having institutions lending on your platform is a validation of your methods. So they're welcome for that reason as well. The due diligence is an important element in why people like to have them. So for example, Metro Bank, which is just listed on the stock exchange and which is one of the new challenger banks in the UK, is lending money to consumers via Zopa, which is the oldest of the consumer lending platforms. Was founded in 2005 and was the first peer-to-peer lending platform anywhere in the world. Was founded in the UK by a group of guys who used to work at Egg, for those who remember Egg. Now, also, we've got, particularly via Funding Circle, I think it's definitely a dozen, I think it's probably close to 20 now, local councils who are lending a portion of their own money to local businesses. In other words, you qualify by living within the council boundaries, using Funding Circle to do so. Funding Circle is particularly the platform they choose. Quite a lot of councils work with Funding Circle in order to provide lending to local businesses. So it's being used in a local way as well in quite a number of parts of the country now. In the US, it's not mentioned here, I mentioned it later, but in the US, one of the largest business lenders, which is called OnDeck, and is listed on the US Stock Exchange, now has a partnership with Chase Bank, part of JP Morgan, in which Chase will use OnDeck's online technology to lend money in a sort of peer-to-peer fashion to small businesses. And that's effectively they're just licensing the technology. But it's a major partnership, and of course JP Morgan is one of the biggest banks in the world, but they're starting to use the technology. So the two are moving together in all sorts of ways. And then here, Syndicate Room, which I mentioned partly because I happen to be an investor in Syndicate Room, so I'm rather proud of them, has just become a member of the London Stock Exchange. Syndicate Room is an equity crowdfunding platform, obviously therefore not involved in providing loans, but involved in arranging the sale of shares. And Syndicate Room, as it says, has just become a member of the London Stock Exchange, which is going to enable them to offer investors who register with them access to initial public offerings of companies that list on the London Stock Exchange, and to secondary share issues, so additional fundraisings after an IPO by smaller companies, particularly smaller companies. So again, the startup market of private companies starts to merge with the public markets where freely tradable shares are traded. The two things are sort of gradually moving together. So those are some of the ways in which that's happening, but that I think is a very, very clear, very definite trend. And we'll see lots more examples of it. However, we've also seen some real problems. Some of these you might even have read about if you follow this. There's a peer-to-peer lending platform in Sweden, or there was, called TrustBuddy, which went bankrupt in October last year, finally. It subsequently turned out that the people running the platform had been failing to distinguish between the money that people provide in order to lend and the money that they use to pay the wages. Unfortunately, that leads to the people who lend money losing. And they did. Not an enormous sum, but I mean, for the people involved, meaningful. In China, by contrast, the sums were enormous. The Chinese police closed down a platform called Yizhubao, having uncovered a $7.6 billion Ponzi scheme in which lots of people lost a lot of money. But then the numbers are always bigger in China. However, there are some other slight problems that are starting to crop up as well, and we got a sort of a hint of one there. There's a large platform in the UK called RateSetter, which mainly arranges loans to individuals, but increasingly lends to businesses as well nowadays. They have a thing, or they have, since the beginning, they were the inventors, the first people to have it, a thing called a provision fund, whereby they siphon off a little bit of every pound that's lent on the platform, put it into a fund which is designed to provide every lender with a guarantee that if a loan goes wrong, the money will be covered out of the provision fund. So it gives you a guarantee against loss. It's sort of a mutual insurance, effectively, against loss. But of course, there haven't been terribly many losses, and quite a lot of money is built up in the fund. And unfortunately, the people who run RateSetter somehow developed the idea that this money could be used for purposes other than sitting in a bank account and providing insurance. So they started to use it to lend. Once this was disclosed, they very quickly stopped. But it illustrates a problem which I'll come to. I mean, I think that was a very, very misguided thing for them to do. But it was done for a reason which is important in understanding the evolution of the movement. And as I've said, banks are starting to build their own online propositions that look to the borrower very like a crowdfunding type of platform, but instead of being funded by lots of individuals, it's funded by the bank. So there are sort of problems, threats starting to come out. So then, just to quickly conclude, what I think the big trends and questions about this whole thing are. I think clearly, firstly, it's no longer a pure peer phenomenon. The ideal of peer-to-peer, something alternative, something different to the conventional, is disappearing. And it will disappear, I think. So what's it all about then? It's not, I think, really about being alternative anymore, because I don't think you can really argue it is alternative anymore. I think it's becoming part of the mainstream of the way finance is done. What I think is different about it, and this is probably the way that we will end up thinking about it, is from a lender's point of view, it's giving you access to types of investments that you could not get access to before. So it's simply a way of letting you into markets that as an individual you couldn't get into. So, for example, it was very difficult for me, unless I became a loan shark, to lend money to other consumers and to gain interest from doing so, or indeed to lend money to a business, or indeed to invest in a mortgage directly, an individual mortgage. So what's happened, although it was not impossible, it was very difficult for me to invest in the shares of startup companies with small amounts of money, because those deals would typically be done by angel investors who are wealthy people with large amounts of money. So it's become, I think, a phenomenon that's really more about access than it is about being a genuine, very distinct alternative to conventional sources of funding. I think they're merging, and I think really now the game is, what sort of assets can I invest in? What sort of return can I get? What does it take to play? Another big question is pure technology versus tech plus human. Adair Turner very noticeably suggested the other day that when this movement goes wrong, which he is sure it will, the lending that's been done through these platforms will make the bankers look like geniuses. What he means by that is the lending that's been done by pure technology alone, in other words, by algorithmically driven credit decisions with no human intervention. And some people are doing that. Funding Circle in particular is the largest and is very dependent on its algorithms in order to make its credit decisions. A lot of people are veering towards the tech plus human mix. In other words, that yes, you use technology to speed up elements of the process, to make the thing more efficient and more scalable, but you cannot get away from the need to have experienced, sensible human beings looking at things and sense-checking them. And you need both. So there's a sort of area of uncertainty there. Then the big question is, can pure intermediaries remain viable? And this is the RateSetter problem that I was talking about. So a really sort of conventional peer-to-peer model is a company which is simply a matchmaker. It has borrowers on one side, lenders on the other, and it provides the forum in which they meet and do deals. It doesn't put money into the deals itself. So it is not a balance sheet lender. It does not have a balance sheet from which it lends money to the borrowers that approach it. It's a pure intermediary. Now, there are lots of people that think that can't last for all sorts of reasons. One, because in order for the company to grow, unless it is lending in the deals itself, unless it has what's skin in the game, as it's often called, it will tend to lend to worse and worse risks in order to achieve faster and faster growth. It doesn't have an incentive necessarily to be careful. Skin in the game makes you careful. So there's that question. There's another practical question, which is certain sorts of lending are quite difficult to do with a peer-to-peer model. And the reason is that if I'm a property developer, let's say, and I want to buy a building, or I've been to an auction and I've bought a house that I want to convert, I need the money to pay the auction house fast because I'm on a short deadline to produce the cash. The problem with a peer-to-peer proposition is I can't tell how long it's going to take for the money to come to fill that loan. Therefore, I've got a real concern about borrowing from these people, even if the rates are good, because I can't be sure I'm going to get the money in time. What RateSetter was doing, and this is particularly a problem with property developers, property loans, which they tend to be big, and also they tend to be needed fast in order to complete deals. RateSetter's problem was they wanted to fund those deals, but because they didn't have a balance sheet of their own, they were dependent on other people turning up fast enough to fund them and to give the borrowers security that the borrowing would happen in the time limit they wanted. So what did they do? Provision fund. Perfect. We'll use that. So what they were doing was filling the loans from the provision fund as if it was their own balance sheet, and then effectively reselling them to the market as they turned up and putting the money back in the provision fund. So they need a balance sheet. That's the point. You need a balance sheet in order to make you careful and to make you take care about risk, but in some terms you also need one because you can't do certain deals if you don't have one. So there's a real question about, can these guys get by without actually having their own money? And nobody quite knows the answer to that. Next question, has P2P growth peaked already? Well, it's slowing down. And it's already, 80% year-on-year growth is very good. And as the numbers get bigger, 50% year-on-year will be a very large sum. But has it already kind of peaked at a point where its ultimate size will only be quite a small fraction of the overall market? Or is it going to go on and become very big? That's a moot point. And are there too many conflicts of interest? Are there too many problems with the model? In other words, let's take the example of Crowdcube, which is the largest equity funding platform. And if anybody is interested in knowing more about the inside story of these things, I would strongly recommend you read a blog called The Truth About Equity Crowdfunding, which is written by a very smart guy who was turned down for a job at Crowdcube, much to their subsequent chagrin, I suspect, because he's very good at due diligence and he spends a lot of time analysing the deals. And almost nothing comes out looking good from that process, but well worth reading. I read it religiously. And there are lots of conflicts of interest in the model. Crowdcube only get paid when a deal actually goes live on the platform and funds. So do they have an incentive to tell people your valuation is too aggressive? Or indeed your business plan is nonsense? No, they don't. And they're in a market where everybody expects 7, 8, 9 out of 10 deals to go wrong anyway. So it's no surprise when they do. So, I think there are a lot of questions over the ethics, the conflicts of interest, the amount of risk to which retail investors are exposed. And those things are in play at the moment. They're not concluded. The system as it exists now is not necessarily the system that will exist once people really figure out what the risks are. But so I'm sounding quite bearish on this whole movement, I'm afraid. But I think, the time for cheerleading is over, essentially. And the question now is, are these good, strong, viable businesses that are run properly and that are going to be around for the long term. And I think that's not yet clear in a lot of cases. So that's me.